Berkshire Hathaway stock has held up well against the broader U.S. indices for the last several years. This is despite the fact that their cash balances continue to increase. Most recently, they reported over $300 billion in cash in U.S. Treasuries, short-dated U.S. Treasuries. So this prompts the question, why is Warren Buffett hoarding so much cash and short-term U.S. Treasuries? And in this video, not only that, we're going to cover their most recent results and underlying valuation, my thoughts on Berkshire, why, I've covered several videos on them. Broadly, I continue to like them. I continue to like the setup. So let's dive in to understand what's going on. As always, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment content, please make a point of hitting that thumbs up, hit that subscribe button. Let's dive right in to understand what's going on. So first of all, is this a call on economic doom, high unemployment, stock market crashing? Not necessarily. I think it's important, as always, to deal with reality, and then you can explore conjecture later. So the reality is, I don't think this is necessarily a call on economic doom. I think, very simply, it's Warren Buffett sold $133 billion of stock so far 2024, and he only bought around $6 billion. And he took all of that and reinvested it in U.S. Treasuries. So you can see how about $100 billion from stock sales went into about $100 billion in U.S. Treasury bills, short dated. I previously did videos on why he may have been dumping Bank of America stock, and he'd been selling billions of dollars of Bank of America stock. And that, I think, was due to their sizable losses in their loan portfolio due to mark-to-market accounting, and how they had provided a lot of loans at short interest rates or low interest rates. And as interest rates moved up, it resulted in huge losses on their balance sheet. That, though, I'd argue is a rounding error relative to Apple, because if you look at the footnotes to the Berkshire Hathaway filings, you can see at the end of last year, December 31st, 2023, they had around $174 billion in Apple. Now that's only around $70 billion. So that's a clear $100 billion in Apple stock that they've sold. Bank of America is also lower, going from $35 billion to $32 billion. So a couple billion there, but really the vast majority is from Apple being sold, that $100 billion. So why is he selling Apple? And I think this is an important, just standalone point. Warren Buffett is very mindful of taxes and long-term compounding. He would rather sit on something for years and decades to come. One could look at his track record with, for example, owning Coca-Cola throughout the dot-com bubble when it got to like 50 times earnings, and he just held through that whole period, collecting his nice dividends. I think he's looking at this, and him selling is a clear indication that he would rather pay, keep in mind, tens of billions of dollars in taxes, a 20% tax rate on a $100 billion sale, and a lot of that's profit. So, tens of billions of dollars in taxes that he's going to be paying, versus the outlook for Apple. And here it is. I'm going to AI Ticker Chat running the predict feature to think about what does AI think. And it's looking at the tepid growth. It's looking at possible margin improvement, but, a multiple range of, let's say, 18 to 32 times. And it's saying the outcome's just not that compelling for a multi-trillion-dollar market cap stock. What you're talking about is $108 billion in free cash flow last year versus that multi-trillion. So you're talking about 30 times plus earnings. Now, this is not, dot-com implosion, crazy valuation, but it's also just not cheap, especially for sluggish growth. And so maybe he's saying, hey, I'd rather just get my yield on cash. We'll talk more about that on a second. Another aspect is, is he making a call on the stock market being super risky and that it's going to collapse? I mean, if you look at the underlying earnings ratios, the PE ratios, it's not like it's crazy. This is not dot-com territory. You're talking about 24 times in November. A year ago, it was closer to 19 times, 20 times. So there has been some multiple expansion. There is expectations for continued earnings growth. So maybe it's around 24 times. So this is not, I'd argue, the crazy expensive territory. This is not, yes, the markets are at highs, but this is not crazy, 1929 type of scenario, in my opinion. Another perspective is that he's collecting 4 to 5%, sitting short U.S. Treasuries sitting on his cash, and he's thinking, why do I need to, invest in a stock that might not do anything for me for the next few years? So maybe I just pay the taxes and I get, a better yield for the next few years on that. And he thinks maybe he could do even better than, just sitting, getting nothing on the potential return. I personally keep my cash at Interactive Brokers, currently earning over 4.3%. Check out the link below if you're interested in learning more about Interactive Brokers. I think he's also very aware of the U.S. fiscal situation, which is tenuous at best, I'd say, which is that you have profligate spending, a bunch of knuckleheads in Congress that, don't seem to be very mindful of, hey, you don't have an unlimited credit card, and you have a couple of possibly tough choices in the years ahead. Maybe you have, one possibility, depending on how the outlook of, at the time of this video recording, I didn't know who the next presidential, next U.S. president will be. But on the one hand, you have continued profligate spending. On the other hand, you might have some sort of balance between, maybe tariffs and maybe, huge government cut, austerity, maybe even to the tune of trillions of dollars. So there's been that sort of prospect. So you have a lot of this economic uncertainty. But I would say you're seeing several billionaire traders calling out, look, all the roads lead to inflation. This is Paul Tudor Jones recognizing that the U.S. doesn't have its financial house in order, and maybe, short dated cash until that inflation's priced into the market, and then you get much lower valuation. So maybe, that's one sort of theory that he's looking at. I mean, another theory is that he's loading up his elephant gun and he's looking to buy something, for, hundreds of billions of dollars. I ran one of the stock scanners in AI Ticker Chat, and I was filtering for under $300 billion market cap, under 25 times free cash flow, and some nice expected growth in the years ahead in terms of revenue. And, I don't think he's going to be buying Alibaba like Charlie Munger, may he rest in peace, would have. But there are a few things here, maybe. I don't think Merck, I don't think Salesforce, American Express he already owns. So I guess he could buy the whole thing, but I'm not sure what the regulators would say. PDD, another Chinese company, that's not going to happen. Maybe it's Booking. I mean, that could be an interesting idea. Maybe Progressive. I don't know if the regulators would allow that, given that he already owns Geico. So I look at this and I'm not really sure that, this is for elephant hunting. I think this is just, he's looking at his opportunity set and saying, hey, I'd rather get that 4 to 5%, just holding cash in U.S. Treasuries and expecting maybe another shoe to drop, saying, yeah, I'm not saying economic catastrophe. It is a possible unemployment definitely is on the low side. So, you could have that tick up in the years ahead. And, you could have a period where if inflation were to tick up, then valuations could reset a lot lower, going from, let's say, 24 times for the S&P to 15 times. That would be a significant haircut. That could cause a lot of pain, and then he would be in a great position to deploy that cash. So I'd say Warren Buffett, as usual, is in a great position. Let's look at their results and their valuation. First, as always, this is not financial advice. Also, quick plug, recently Eric wrote, I already have an annual subscription. I recently paid for the premium tier subscription as I wanted to upgrade due to your great content. He's talking about Unrivaled Investing. If you're looking for compelling investment ideas, actionable insights, and educational content, come check it out. Prices will be going up this month in November, so lock in the favorable rates now. It is worth calling out that Warren Buffett did not buy any additional shares in the third quarter of 2024. He bought a couple billion so far in 2024, but none in the third quarter, so suggesting that Berkshire isn't at the deeply compelling valuation he previously found. Looking at the underlying segment results, you see Geico, the auto insurer, doing quite well in the third quarter, profitability up nearly double, has had some volatility in the last few years, but doing nicely year to date. Their other core insurance operations, their primary group and reinsurance, not so hot, seeing some losses. However, it's offset by, looking at favorable improvements in their railroad, Burlington Northern Santa Fe, Berkshire Hathaway Energy, showing a nice rebound, $1 billion plus in profit versus a loss last year. Their manufacturing doing well. So mostly this is a story about everything else doing well and some hit to their insurance business. So this is worth digging further in. You can also see in the quarter they had 20 billion plus in investment gains. So that is the investment portfolio increasing in value. That's not investment income. That's the portfolio. Investment income, that's the interest income from the cash that they hold and the treasuries that they hold. This is the change in value of the bonds. This is the change in value of the stocks. And so looking at the losses, you can see, digging into the footnotes, that they did have an uptick of losses and loss adjustment expenses of around $1.3 billion, where this is the key line: estimated ultimate claim liabilities attributed to pre-2024 accident years increased around $800 million during the third quarter. A significant portion of the increases were related to Guard. That's a subsidiary in their insurance group. The reason why this is actually really important and a little bit disappointing is because it's effectively saying, hey, you know, those prior years of insurance, yeah, what we set aside for losses didn't turn out to be enough. So we're going to have to tick that up a little bit more. So those prior years that we said, these are the losses, it's actually going to be a bit more. We're going to recognize that adjustment as an expense so far in 2024 and also in the third quarter. And that has been the key driver of why the results did take a hit in the third quarter. You don't like to see that. I would rather see the conservative underwriting culture of one of my top holdings, Fairfax Financial, which, you know, I've called it out here on this channel before, and I'll be writing about it in my letter this week for Unrivaled Investing subscribers. So in full disclosure, I own shares in Fairfax Financial, where they have a multi-quarter, multi-year history saying, look at our prior reserves, and yes, there are effectively reserve redundancies based on prior years, saying, hey, we recognize these losses from prior years, and actually, you know, those losses didn't come to fruition. It's not as bad as, you know, what we were expecting. So you don't like to see this. This is a bit of adjustment. So you're going to want to understand, well, what's going on with this Guard? Once again, I go to AI Ticker Chat, and chat is completely free to use, so come check it out. I go, what is Guard as it relates to the insurance losses? And it calls out how, look, there's new management at Guard and how they undertook a comprehensive review of claims. Okay, so that's never good to see, a changing of the guard, suggesting, okay, something's not right here. They exited their homeowners business and focusing on tightening underwriting guidelines. Sounds like prior management, sort of dropped the ball, and you're looking at some losses, new management coming in to try to clean it up. Not what you like to see, but that's at least the story for what's going on here with the losses. Looking at their balance sheet, because this is a key part of their earnings power. You have roughly around $300 billion in stocks, roughly $300 billion in fixed income. What a behemoth, around $600 billion portfolio. What are the potential gains that you could recognize on this in the decade ahead? I'm not talking about the interest or the dividend payments. I'm talking about the potential gains and appreciation of either the bonds or the stocks. Let's assume the bonds don't appreciate at all. The cash doesn't appreciate at all in value. So it just sort of mark to market stays at that. So if you assume that their stock portfolio can get 8% a year, 8% on 300 billion, 8% pre-tax, that gets to around $24 billion. You can use your own assessment. You could do 6%, and say it's closer to 18 billion. So, you could think about this, but either way, give or take maybe around $20 billion in potential returns from their equity portfolio, recognizing that there's also the opportunity to invest a lot if they wanted to. But let's not even give credit for that. Let's just assume that it's a relatively fixed amount in terms of stocks, and that it can appreciate a couple percent, mid-single digit, high single digits per year, generating, roughly $20 billion in value. And then you look at their underlying operations, and you can see their core segments, generating, between the interest income as well as insurance underwriting profitability, their core segments, maybe somewhere between $34 and $45 billion, $35 to $45 billion in core earnings per year from their various different segments. This is a very diversified snapshot against, the global economy, the U.S. economy, You have limited displacement risk. If one segment starts, under earning, management can reinvest the cash. So I love the fact that you're very well diversified. You have rationality at the top of the company, and they have the whole world as their opportunity to invest. And so combined between their stock portfolio and their core earnings, maybe around $60 billion, give or take, of earnings power. This shows you sort of the estimates that, go into thinking about a business like Berkshire Hathaway. And you could see Berkshire B shares around $442 per share today. That's around $950 billion market cap for Berkshire. Once again, I'm giving a range of what their normalized earnings could be, saying around 60 billion, maybe it's closer to 55, maybe 65, but it's not in a crazy valuation. You're talking about a teens type of multiple relative to their earnings power. What do you think it can compound at in the years ahead? Think about organic growth rates, somewhere between 5 and 10% a year. This is based on my own experience shopping at See's Candy, where, man, they raise their prices each year. And, look, they're 5%, I think, is probably on the reasonable side, unless there's, it is possible that you have true disruption in the years ahead. And you would see that across several different segments. For example, if you have electric trucks, being driven by themselves, maybe, how does that cost compare to using Burlington Northern? You could see it challenged across several different segments, but I don't see it getting replaced overnight. And you would see this play out over time, just like how you're seeing their insurance, business go through a transition right now, or, changing of the guard. And looking at earnings multiples, thinking about where it is in the years ahead. Keep in mind, this is a hypothetical. Stock price can go way higher, way lower based on, the execution, based on market assessment, the market temperament, external events. Thinking about maybe it gets, this is a significant discount to where the market currently trades at like 23, 24 times. I'm giving it a discount, 14 to 18 times. And based on that, you're effectively talking about low single-digit % potential return over the next 5 years to maybe it doubles over the next 5 years based on, the growth of the business, based on getting 18 times. And then, by the way, there is tens of billions of dollars in cash that's accruing to you as a shareholder each year. So that's another 2 to 3%. So overall, I'm looking at this and I still think that this is quite reasonable relative to many other companies out there. And so I have called out Berkshire over the last few videos saying I liked it. I continue to like Berkshire. Would not be surprised if this outperforms, the broader U.S. financial indices, as it has done for its multi-decade history and more recently. And so I continue to like it. I think you're not talking about a revolutionary company. You're talking about a company that's well positioned in this current environment, which includes a well-diversified base of core operations, a huge cash pile that can be used opportunistically should an external event happen. If oil prices were to jump from $70 to $170, Berkshire Hathaway would survive that. They would probably thrive during that period as well, because then equity prices would reset. They could take their $300 billion and invest a lot of it, getting much higher, returns. So I view this as even if the world doesn't have chaos, there's a chance that this does quite well, quite reasonably in the years ahead. If there is chaos, if inflation does pick up, if there are challenges, I would say, yes, you'll see that sell off. Like it seems to almost always sell off when there's, some sort of catastrophe or concern. I mean, there was a divergence during the dot-com bubble implosion where Berkshire did well and everything else didn't. But I look at this and I think, it's very reasonably positioned. You have, and by the way, if you think interest rates are going to stay here or potentially go higher based on the comments of Paul Tudor Jones and other billionaire traders saying, hey, the U.S. House, financials is in disorder, and that, there's going to be potentially higher interest rates, that for a company that's holding $300 billion in cash, that's great. They could say like, okay, we're just going to sit and wait to deploy our cash. If no crazy bargains come, we're still going to be getting a minimum 4 to 5% yield on that. If rates go higher, even more. And that's just pure, profitability, pure free cash flow. The bigger risk, in my opinion, is you get some sort of crazy regulatory environment where they start saying, hey, we're going to start taxing unrealized capital gains, that sort of development where Berkshire could be forced to sell, that you don't want to ever be in a position of for selling. I look at Berkshire and I think it's not a crazy valuation, history of execution, a lot of sort of call options in case, there is catastrophe out there. So I continue to broadly like it. And I think a lot of insurance companies that are conservatively underwriting and have a reasonable cash portfolio that's short dated, short maturities, they could do quite well in this environment. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. You've been watching Unrivaled Investing.